My name is Claire. I'm a senior analyst on the investment team, and I'm here today to give an overview of how our strategy performed in 2022, with a particular focus on the fourth quarter. And then we're going to spend a bit of time on the outlook for 2023 as well. So what happened in 2022? Well, the first big theme was the huge outperformance of fossil fuel energy companies. You can see here on the left that the energy sector, which currently doesn't include cleaner energy, saw massive absolute returns of over 60% in 2022, far outperforming any other sector in the MSCI World Index. And the performance was so strong that the energy sector almost doubled its weight in the index during the year. And it's not hard to see why. This chart plots the 2022 energy spike against historic changes in energy prices. And what it shows is that on a rolling 24-month basis, in percentage terms, the 2022 energy spike was the worst since the 1970s. This enabled fossil fuel energy companies to reap windfall profits, and investors piled into these companies with a fairly short-term lens, looking to get a piece of the action. And that was a headwind for our strategy because we don't invest in fossil fuel energy companies. We think that over the long term, that's going to be a declining sector amid the sustainable transition. And the second big theme for 2022 was this rotation from growth to value styles. We bore the brunt of this in the first few months of the year, although, as you can see, it did continue to some extent throughout 2022. And this was also a headwind for our strategy because we tend to buy companies with exposure to sustainable growth themes, which means we tend to have a positive bias to growth. More positively, though, one bright spot from 2022 was the surprise resurrection of the Inflation Reduction Act. Despite its name, the IRA is actually a huge boon for the clean energy sector because it contains about $400 billion in clean energy funding. And we saw this be a huge driver of companies towards the end of the year, and it did enable our cleaner energy theme to generate pretty strong performance, although that wasn't strong enough to offset the headwinds I mentioned previously. So in this context, our strategy underperformed the MSCI World Index by about 10% net of fees over the year. That was mostly due to risk factors, predominantly the rotation from growth to value that I mentioned earlier. Stock selection was also a negative impact, although it was far less significant. And this is how our performance looks with a longer term context. And now just zoning in on Q4, we actually had a much more positive end to the year, with our strategy outperforming the index by about 1.7% net of fees. On a thematic basis, we saw positive relative performance from 7 out of our 9 themes, with water management and resource efficiency being the weaker two. The thematic selection effect was a mild negative during the quarter, and that captures the impact of not owning all of those companies in the MSCI World Index, which aren't in our investment universe because they're not thematic. And in this case, it's capturing the relative rebound of technology companies like Microsoft and Apple, which aren't in our investment universe. So that was a mild negative during the quarter. And if we start out by looking at some of the weaker names during the quarter, I mentioned that water management was our weakest theme, and that was led by advanced drainage systems. So ADS is a leading provider of stormwater infrastructure pipes, which are made from predominantly recycled plastic. Not only are these much better for the environment than alternatives made from concrete and steel, they're also cheaper and they're easier to install as well. So we think that ADS is going to see a rising share of the stormwater infrastructure market over time. Meanwhile, recurring extreme weather events like Hurricane Ian continue to bolster the case for spending on stormwater infrastructure. Hurricane Ian was the deadliest US hurricane since 2005, claiming over 100 lives. The picture on the right shows just a snapshot of the devastation it caused. So Florida is a major market for ADS, and it's also where the state that bore the brunt of the impact from Hurricane Ian. So unsurprisingly, the company saw about a 70% decline in shipments to Florida towards the end of Q4 as the state prioritized recovery. But over the long term, we think that coastal states like Florida will prioritize spending on climate adaptation and resilience, which should benefit ADS. Taking a more shorter-term lens, advanced drainage underperformed in Q4 following about a year of really strong outperformance. And that's partly due to the fact that demand for their products is highly correlated with the construction market outlook. So US building permits are typically considered to be a strong leading indicator for the construction market. And as you can see on the left, they've been steadily declining through 2022. That led Advanced Drainage to cut their revenue guidance for this financial year, and it also introduces uncertainties for next financial year as well. However, as you can see on the right, the company has been able to keep their operating profit guidance unchanged. And that's because the company continues to demonstrate phenomenal pricing power, offsetting the impact of volume declines. And that helps us to build conviction in the long-term quality and opportunity for this company. Trimble contributed to weakness in our resource efficiency theme. And Trimble is a pioneer in geospatial technology, which is used to help various machines and equipment run more efficiently. And we thought we'd help you to understand this by giving you an explanation about how this works in some of Trimble's sectors. So in construction, Trimble's technology helps to reduce machine time in operation. This saves fuel, which equates to about a 23% savings in greenhouse gas emissions compared to other machines not equipped with Trimble's technology. In agriculture, they help with field navigation, which also maximizes fuel and helps to save about 6% of emissions. In transportation, Trimble helps commercial fleet operators with capacity utilization and route optimization services, which reduces emissions by about 3%. Now, although in percentage terms that's lower than the other sectors, in absolute terms it's massive because the total greenhouse gas emissions of the transportation sector is about 100 times that of construction. Like Advanced Drainage, Trimble is exposed to weakening cyclical demand from the construction and also the industrial markets. And that's really been reflected in a decline in their product revenue over the last couple of quarters, which basically corresponds with hardware sales. Importantly though, a key part of our thesis for Trimble is that they're going to keep being able to sell their subscriptions, because this is the technology that helps their customers to cut emissions and cut costs. And as you can see on the left, subscription revenue has still been steadily rising for the company. Not only does this improve earnings visibility, it also improves the company's margins, because a subscription sale gets a gross margin of about 72% compared to about 52% for a product sale. So now turning to some more positive stories, I mentioned that our strongest theme during the quarter was sustainable transport, and that was led by Infineon, which is a leading global producer of power semiconductors. Infineon lives in our sustainable transport theme because nearly half of its business is exposed to the auto sector, and the transition to electric vehicles is a huge opportunity for Infineon. Today, a full battery electric vehicle contains about $1,000 in semiconductor content, and we think that could rise to $1,500 by 2025 as EVs become even more advanced. And that's about 2 to 3 times the amount of content in an internal combustion engine vehicle. But although Infineon's in our sustainable transport theme, they also benefit a whole number of other cleaner energy technologies as well. You can see on the right that wind, solar, and storage technologies each contain thousands of euros per megawatt in semiconductor content, compared to 0 for fossil fuel technologies. In fact, semiconductors are so crucial to the sustainable transition that just in this last quarter, Infineon has been able to upgrade their long-term target operating model. Previously, they were looking for about 9% revenue growth through the market cycle, and they're now looking for over 10%. And that's predominantly due to strong double-digit growth rates from the e-mobility and renewable energy sectors. Meanwhile, the operating leverage from a higher revenue base, as well as various cost efficiency measures being taken by the company, has also enabled them to raise their margin target from 19% to 25%. Our second strongest theme during the quarter was cleaner energy, and this was led by Vestas Wind Systems, which is a leading wind turbine manufacturer. And our thesis around Vestas really lies around the step change in global wind capacity that's going to be needed in order for the world to achieve net zero emissions. You can see on the left the IEA's forecasts, and they're looking for over 300 gigawatts a year of global wind capacity in order for the world to achieve net zero by 2050. On the right, you can see WHEB's own forecasts. And in fact, we're only looking for about 175 gigawatts. which is about in line with currently announced government pledges, but is far short of the 300 gigawatts that we actually need to achieve net zero. So what we're hoping is that governments will finally get their act together and come through with the necessary wind capacity so that we could see upside to these forecasts and also upside to Vestas's share price as well. Recently, though, the wind sector has hit a bit of a roadblock, partly due to COVID, but also in part due to policy uncertainty, particularly in the US, where developers were waiting to see whether a production tax credit would be extended before committing to new projects. And as you can see on the left, this led Vestas's profitability to take a bit of a nosedive as the impact of cost inflation interacted with a weakening demand environment. Thankfully, though, the IRA has provided some much needed certainty. Not only has the production tax credit been extended, they've also introduced various other initiatives to incentivize manufacturing and development of renewable energy. This led to a surge in order intake for Vestas during Q4. We think about 4 gigawatts, although the actual number is yet to be announced. And that follows 5 consecutive quarters of order declines. Also, Vestas has been able to put through soaring price rises, which should provide a further tailwind to get their profitability back on track. So that hopefully gives you a picture of how our strategy performed during 2022. But what do we see on the horizon for 2023? Well, the ways we see it, there are 2 major themes on investors' minds at the moment. And the first is the rising risk of recession, particularly in America, given that economy's importance in the global economy. And one factor which we think might be preempting a forthcoming recession is the currently inverted yield curve. Because an inverted yield curve has accurately predicted each of the last 8 recessions with no false alarms. And you can see this on the left-hand side. So that black line is the relationship between short and long-term US Treasury yields. So it essentially represents the yield curve. And when that dips below the green line, that indicates a yield curve inversion, which, as you can see, is very quickly followed by a red block, which indicates a recessionary period. And as you can see, we are currently well below that green line. So we're in a deeply inverted yield curve environment, which could be indicating a forthcoming recession. Interestingly, though, the economist that came up with this theory, Campbell Harvey, has recently gone on record to say that he thinks this time it could actually be a false alarm. He's a bit of a lonely voice, though. Most of the economists that you speak to at the moment will say that they put the probability of an American and a global recession this year to be quite high. And in fact, you can see the World Bank's forecasts on the right-hand side. They've recently revised down the US GDP growth rate for this year all the way down to 0.5%. And they've warned that the global economy is perilously close to falling into a recession. Another factor which might lead us to think that a recession could be on the horizon is this rising trend of unemployment. 2022 saw a number of tech companies make huge layoffs as they struggled to adapt to a slowing growth environment. But as we come into 2023, we've started to see that spread to other sectors as well. Goldman Sachs, McDonald's, and even Tesla in our sustainability domain have recently announced quite significant layoffs amid the market uncertainty. Interestingly, though, we think the trend towards labour shortages and wage inflation for our companies is probably not going to go away anytime soon. And that's because the University of Massachusetts has recently released research which shows that the IRA should create 9 million new jobs over the next 10 years, of which 5 million are estimated to be directly related to sustainability sectors. On the right, we've taken just a snapshot of the policies from the IRA, which we think are going to be most pertinent to the companies in our portfolio, and those alone create 2 million jobs. So that's something that we'll continue to work with our companies on as they seek to balance the huge windfall benefits from the IRA against this potential growth constraint and wage inflation. And the other major theme on investors' minds is still this relationship between inflation and interest rates. Because we have seen American inflation come down over the last few quarters, as you can see, and we've also seen investor expectations for inflation to come down as well. So that green line is the probability of inflation being above 3% in 5 years' time. And that's come all the way down to 30% now. So that indicates that most investors think that we are through peak inflation. But that still creates uncertainty about where and when Federal Reserve banks will stop hiking interest rates. Theoretically, an improving inflationary environment should enable federal banks to take a much more dovish stance, but so far we've continued to see them press on with rate hikes. Meanwhile, in policy land, one thing that we're going to be looking for this year is the European Union's response to the Inflation Reduction Act, because the IRA hugely tips the balance in America's favour for renewable energy development and manufacturing. And the EU is worried that some of the provisions, particularly around domestic content, are going to entice companies to build manufacturing capacity on American and not European soils. Now, Ben in the investment team likes to hark back to the days that he was working on the IPO of SMA Solar, which at the time was an up-and-coming German solar company. But looking back, unfortunately, SMA's story hasn't been the success story that Ben might have hoped for. You can see on the left that SMA is number 6 in global solar inverter shipments. But what you can't easily see from this chart is that they've been slowly slipping down because Chinese companies, which are much cheaper for the same technology, are taking increasing share from SMA Solar. Meanwhile, higher tech premium companies like SolarEdge, which is in our portfolio, has also been climbing up the ranks as well. And so SMA has been gradually squeezed out of the solar inverter market. And honestly, you could recreate this chart for plenty of other European solar companies because the union has really lost its grip on the solar industry. And they're not going to want to see that happen for other clean energy technologies like wind. And so we are expecting the EU to come out with some form of response to the IRA. And we think it could follow the blueprint of the European Chips Act, which was announced last year. That introduces about 43 billion euros in public funding, which is intended to double the EU's share of global semiconductor manufacturing capacity. So it's possible that we might see rumblings of an EU Clean Energy Act along this line in 2023. Finally, one thing that we're looking for this year is a re-acceleration of public health spending, because the COVID pandemic has really highlighted that plenty of public health systems have long been underfunded. And although historically the trend has been to only accelerate public health spending during a crisis, there is actually plenty of evidence to suggest that it's much better, both from a cost management perspective and a patient outcomes perspective, to take a much more steady and deliberate approach to public health funding. So we are hoping to see governments make pledges to that effect this year, although if the current strike action by NHS workers in the UK is anything to go by, it's fair to assume that the UK government at least has yet to see the light. Nonetheless, we do have a number of companies in our portfolio which benefit public health in a number of ways, and they should benefit if we do see a re-acceleration of public health spending. So what does that all mean for stock markets? Well, we wanted to draw your attention to this really strange phenomenon which we noticed at the end of last year, which is this CBOE equity put call ratio. So this chart maps the relationship between put options and call options purchased by investors. And essentially all you need to know to understand this chart is that investors buy put options when they think markets are going to go down, and they buy call options when they think markets are going to go up. And so this ratio historically has hovered around 0.5 times as investors have broadly expected markets to keep going up. However, as we got to the end of last year, and I mean literally as we were just tipping into 2023, we saw a surge in investors buying put options, which led this ratio to reach a record high. And that seems like an extremely bearish signal to us. And in fact, we think it's quite strange because although we can see the case for why there is some uncertainty around 2023, there's also plenty of positives as well. For example, the improving inflationary environment and potential dovishness from federal banks around interest rates, as well as things affecting our sustainability themes like the IRA and potential re-acceleration of public health spending as well. So I think it's fair to say that we're taking a much more balanced outlook for 2023 compared to this bearishness by a lot of investors. And I think with that, I'll hand over to Seb.
Thank you very much, Claire. Good morning, everybody. So I'll just share my screen now as well. So hopefully you can see that. So I'm going to spend about 10-15 minutes just talking about two things that we've been working on over the last over the last few months, and more recently for the SDR, the carbon reduction commitments that we've made and the progress that we're seeing against those, and also our response to the FCA's sustainability disclosure requirements, which are currently out for consultation. So just on the carbon reduction commitments, so we, as some of you hopefully will remember, we set some targets back in 2020 to get our portfolio businesses to all set net zero carbon commitments. And you can see this chart shows you the progress that we've made since December 2019 on that objective. These commitments are commitments that cover just scope 1 and scope 2 emissions. So this is the operational emissions that our portfolio companies have, and it doesn't include scope 3 emissions, and importantly, the positive impact of the products and services that most of the companies we invest in are selling on in terms of greenhouse gas emissions. But it does cover their scope 1 and 2 emissions. And you can see how over those 3 years, we've really seen a very significant shift in the number of net zero carbon commitments that our portfolio businesses have. In fact, in 2020, when we set our targets, our near-term target was that 50% of the portfolio should have set a net zero carbon target by 2025. And we actually hit that target at the end of last year in December. We had 55% of our portfolio that was committed to net zero carbon emissions. So we've seen really very dramatic improvement over that period. So just putting this into sort of a graph form. So this is the old net zero carbon target, a 25% reduction, 50% of the portfolio committed to net zero carbon by 2025, and then 100% by 2030. And then this is our progress to the end of last year in terms of the portfolio. So you can see only 45% of the portfolio don't have a commitment now. And we've now agreed to set a series of more aggressive targets now, which you can see here on this chart. So by 2025, our target now is that 85% of the portfolio's carbon emissions will be covered by a net zero carbon target. And by 2028, the full portfolio will be covered. We are shifting our focus away from the proportion of our investments that have a net zero carbon target. That was the old target. And the new one is focused on the proportion of greenhouse gas emissions that are covered by a net zero carbon target. And the reason we've done that is because over 75% of our emissions actually come from just 5 companies. So our top 5 companies represent about 75% of emissions. The bottom 5 represent less than 1%. And we think our targets really should be covering where the emissions are rather than just where our investments are. So that's why we've slightly altered that target and have brought it forward as well. So we've got a more aggressive target to hit. So that's the target on commitments. But of course, these are just commitments. It doesn't actually address absolute greenhouse gas emissions. And we have set targets around that as well, which is indicated in this chart here. So by 2030, we want to see a 50% reduction against the 2019 baseline in terms of portfolio carbon emissions, scope 1 and scope 2. And then by 2050, we should be at zero carbon. And these targets mirror those that the Net Zero Asset Management Managers Initiative are recommending. Although in our case, this covers all of our investments. There are many other asset managers that are signed up to that initiative, but it doesn't cover their full proportion of investments. For us, it's 100%. This, though, isn't as aggressive as, I think it's worth sort of pointing out that this is not as aggressive as what the UN suggests we need in order to achieve or to avoid global warming of more than 1.5 degrees. You can see their models are indicating that we need to see a 7.6% reduction in emissions per year out to 2050. You'll see that it's still there are still emissions in 2050 according to that UN model, but that's because they're assuming that there will be carbon capture and sequestration technologies that are actively pulling carbon out of the atmosphere to offset that residual level of emissions. So those are the targets. In terms of our performance, This is how we've done through to the end of 2021. We haven't yet got the data for 2022. Slightly strange looking curve. And really that was due to the fact that in 2021, some of you may remember, we sold a business called China Everbright Environment Group, which is a waste to energy operator in China. We no longer consider waste to energy to be a solution to a sustainability challenge, largely because of the greenhouse gas emissions that it produces. And so we sold that in 2021, and that dramatically reduced our carbon footprint by nearly 75%. 75% of our emissions at that point came from China Everbright, and we sold it. So that led to a dramatic reduction that you can see. Of course, while it reduces our carbon footprint of the portfolio, it doesn't mean our selling the stock doesn't mean that those emissions aren't still being produced. And so this graph doesn't really reflect real world changes, but we have measured that as well. And you can see in this next chart, that little orange line at the top there, again, running to 2021, that is the reductions that we're seeing from portfolio businesses that we've owned throughout that period. So this is actual real world emission reductions from our portfolio. And you can see it's about 5% per year. So not too far away from the targets that we have set as part of the Net Zero Asset Managers Initiative. Still a way to go though, before we are at that 7.6% annual reduction that the UN says we need. So this is data that we will report annually going forward. So hopefully we will see that orange line come down below the dark one and perhaps even start approaching the dotted line as well. That's what we need to see, but it's an extremely difficult target to hit. So I hope that's helpful in terms of how we're doing on our Scope 1 and Scope 2 carbon emissions and the commitments that we've made. I did also want to spend a bit of time just talking about the sustainability disclosure requirements that are being proposed by the FCA. And this is an area that we have been doing an awful lot of work on over the past month or so. We think that these proposed regulations are genuinely going to create the biggest shakeup in the UK sustainable investing market that there's ever been, really. So we think it's very important that they get it right. For those of you that haven't been following it in detail, just very quickly, the SDR basically sets out a framework for a set of labels that UK funds will have to use if they want to market themselves as being sustainable in some way. It is explicitly aimed at clamping down on greenwashing and trying to make sure that where funds call themselves sustainable, that there is genuine legitimacy to those claims. And critically, and rightly in our view, their focus is very much on sustainability outcomes rather than more generalized ESG ratings. So under the current proposals, it won't be enough to integrate ESG issues into your investment process and then claim a label. There has to be an explicit sustainability objective that's behind the fund. And we think that's a sensible development. So the three labels that they've got in the proposal are shown on the slide here. The first one on what's called the sustainable focus products. This will be on products that invest in assets that a reasonable investor will consider to be sustainable. At least 70% under the proposals will need to meet a credible standard of social and environmental sustainability. And the fund manager will have to report various indicators that show how the assets held in the fund are aligned with this sustainability objective. So that's the first label on sustainable focus. The second one is on sustainable improvers, which is for products that are investing in assets to improve the sustainability characteristics of those assets, particularly through stewardship and engagement. And again, managers will have an obligation to report various indicators on how they're improving the sustainability characteristics of those assets. And then finally, the third one, sustainable impact. This is for products that can show measurable positive impacts in the real world. But critically, the emphasis in the proposals is not on the positive impacts of the underlying investments, but on measuring the positive impact of the investors' activities. And they focus in particular on products that address underserved markets and products that address market failures. So those are the three labels. We've submitted our response to the consultation to the FCA, and although we cover quite a number of different points, overall we think that this is long overdue and that sustainability marketing does need to be more tightly regulated. And so overall we are very supportive. We think this is the right thing for the FCA to be doing. But, and there is quite a large but, there are two areas in particular where we think that actually the proposals could be quite damaging and would set us back. The first is primarily related to the sustainable impact label and the decision that the FCA has made in the proposals, at least, to focus on the investor contribution. So that's the positive impact that the investor is having rather than the positive impact that is delivered by the underlying investments. We think both are important. So, for example, in the slide here, I've got a quote from our impact report last year from one of our portfolio companies, Smurfit Kappa, where they acknowledge the important role that WHEB has played in helping them develop a more sophisticated approach to sustainability. And we think this is really important. We think it's a very important role for us to play as long-term investors to help companies that we own become better at delivering sustainability. But equally, we believe that the reason people invest in us is primarily due to the focus that the companies we invest in are providing solutions to sustainability challenges and the positive impact of the products and services that they sell. And we capture this, as many of you know, in our impact calculator. And under the current proposals, none of this enterprise contribution, that is the impact delivered by the portfolio holdings, none of that really is recognized in the sustainable impact label. It's really focused on the investor contribution. And we think that's very confusing for our investors, particularly retail investors. And it makes it essentially impossible for any listed equity strategy to use the sustainable impact label, or indeed even to use the word impact. So we've made some suggestions to the FCA how we think they could change that to ensure that genuine impact strategies in listed equities can still claim this sustainable impact label. And then the other set of issues are really around the detail in the label definitions and where the thresholds have been set. So in each label, there's a clear question still. What is a credible standard of social and environmental sustainability? That's the key language that's used for the sustainable focus label. And it's not really a very easy question to answer, and there isn't that much guidance in the consultation. Similarly, with the improvers label, what are measurable improvements in the profile of the underlying assets? How will managers report credibly against what they're trying to do? And then finally, under the sustainable impact label, it's unclear whether only strategies investing in underserved markets and areas of market failure will qualify. And if that is the case, how tightly will the FCA define those areas? And is it really only about concessional finance, where you're accepting a lower rate of return in order to provide some support to underserved markets or address market failures? And if that is the case, how relevant really is that to the retail market? So there are some serious questions there. And then finally, the final point here, which is in many ways perhaps the most relevant to many of you on this call today, is around this 90% threshold. So you can only use each of these labels if 90% of the investments in the portfolio qualify under that definition. And this also will apply to fund of funds and other managed funds, making it very difficult if you're trying to provide a reasonably diversified product. If you need to have 90% in each of these in a label in order to claim that label, then that makes it very difficult to have that diversification. So we're feeding back on that as well. So just to conclude, as I say, we've done an awful lot of work on this. We've spent a lot of time talking to our peers in the market who also have, credible impact strategies. We've talked to wealth managers, we've talked to clients, collaborative bodies who are all responding to this consultation, whether it's UK SIF or the Institutional Investors Group on Climate Change, GIN, the Impact Investing Institute, lots of good people out there who also share many of our concerns. And we've been trying to build a bit of a coalition really to put these messages back to the FCA. So in terms of a timeline, so the consultation finishes tomorrow. So if you've not yet submitted your response, you need to get a move on. We're very happy to share our response if anyone's interested in seeing that. We have sent that to the FCA and it will be published on the website, but not until the consultation's closed. So if you'd like to see that, let me know. We've also published a blog that sets out the key points, so do look at that as well. We are members of the Disclosure and Labels Advisory Group, the so-called DLAG, and that's due to have a meeting in February where we will hear from the FCA in terms of the feedback they've got on the consultation. And then there's another meeting in April where we should hear on update on where they've got to with their thinking, with a provisional date set for the end of June when they're going to publish a policy statement. And they'll also have an implementation timeline published at that point as well. So again, I hope that's helpful. It's a bit of a deep dive into quite a dry regulatory topic, but it is an extremely important area for us and probably for many of you as well. So we would encourage you, if you have the time, to respond to the FCA. So thank you very much, and hopefully we have time for some questions. Thank you.
Great. Thank you, Seb, and thank you, Claire. Just to remind everyone, you can submit questions in the Q&A box at the bottom of the screen. We have gotten quite a few in already. Seb, I'm going to give you a chance to run through those and let you catch your breath before we dive in with you. So let me start with Claire. One of the first questions that came in is about the strategy's performance last year. So was that underperformance over the last year mainly due to the market environment, or were there some stock-specific issues as well?
Yeah, it's a great question. And it was really a combination of both, although the much stronger factor during the year was actually the market environment. When we look at the breakdown of the contribution to performance from risk factors versus stock-specific factors, we do see the majority of the contribution coming from the risk factors, predominantly that rotation from growth to value, which I mentioned earlier. That being said, we did have a few instances of weak stock performance during the year, and I would say they're particularly concentrated in 3 companies which were notable underperformers. And those were HelloFresh in our wellbeing theme, Orpea also in our wellbeing theme, and Kion, which was in resource efficiency. Of those 3, HelloFresh is the only one that is still in our portfolio. Kion and Orpea have both been sold through the year because issues came to light which did cause us to reevaluate our investment thesis. But yeah, we still remain very positive on HelloFresh. The company has been weak this year, but we think that a lot of it is just responding to a weak demand environment, as lots of companies are. And actually HelloFresh has been quite resilient in terms of keeping hold of their subscriber numbers, which is really stark when you look at it compared to their peers like Marley Spoon, Blue Apron, and even delivery companies they're often compared to, like Just Eat and Deliveroo. HelloFresh has been much more resilient in holding on to their subscribers, and we are optimistic that they will see continued subscriber growth over the long term.
Okay, great. And would you say there are any key lessons learned from last year? Yeah,
I mean, so it's kind of tricky because most of the underperformance came from the risk factors, and there are always going to be periods of the market where growth outperforms, value outperforms, and this market this year just hasn't been in our favour. And so in that respect, we haven't really changed anything about our process, and we're still maintaining that bias to growth and to quality. But obviously, as I mentioned, there were stock-specific issues as well, and that is something that we need to continue to be mindful of. We haven't changed anything with respect to our stock selection process, but we have recently introduced a couple of new tools which should help us to just build a bit more structure, I guess, around our decision-making and research. So, for example, we've invested in a new tool called Essentia, which helps to control against behavioural biases in investment decision-making. That does things like send us prompts when a company is underperforming and forces us to basically reinstate our investment thesis and just make sure that we've got all our ducks in a row. So that's something that just kind of adds a bit more control around behavioural biases. And we've also invested in a system called Analyst as well, which is going to be used to help us to further improve our approach to valuation and modelling. And so we're going to have a much more, I guess, in-depth approach to valuation than we've been able to take in the past. And partly that's due to an improvement in resources of the company as well. So I'd say that we haven't really changed anything in our process, but we do continue to improve. We continue to look for new tools that we can use. And yeah, those are just two highlights really that we've made during the year. Okay,
thanks for that. I mean, that really leads into the conversation for the next question when you mentioned the resources for the team. So Seb and Claire, one question was, are there any changes to the team ahead, and have we kind of made any changes this year?
Do you want me to answer that? I mean, I guess in terms of the changes, we have, like I mentioned, we've invested in quite a number of new systems to support the process, whether that's around Essential, like you mentioned, but also tools to help us with modeling of other companies in the portfolio. We've also invested in a number of tools to help us flesh out our impact thinking as well for companies, a business called Net Purpose that we've just started a subscription with to help us with that. So there's been incremental changes to make the process more complete. I mean, that's a never-ending job really, but as we introduce new innovations, kind of providing the support to that. So those have been the main changes that we've seen in 2022.
Great, thank you. Seb, as you see, you got quite a few questions in regards to talking about the carbon targets.
Yeah.
Shall we kind of kick off with the first one? And that was asking about the absolute reduction target. Does that include offsets the corporates are buying? And how do you view those?
Yeah, so a good question. And actually, I meant to mention this on that slide. There was a little part of the column that was labeled carbon neutral, which became popular a couple of years ago and has actually since receded again. There were a number of portfolio businesses that had said they'd committed to becoming carbon neutral, or indeed were carbon neutral, and that really means that they've offset the entirety of their emissions, and so they can call themselves carbon neutral. That language actually has become quite controversial. The EU published some notes recently identifying the term carbon neutral as potential greenwashing, and certainly the target validators, most notably the Science-Based Targets Initiative, explicitly say that you should only be using offsets for residual emissions that you can't otherwise reduce, and that's certainly our approach here as well. You should not be using offsets as a significant part of your strategy to reduce carbon emissions. You may well need to use it for the residual that's left over that you can't reduce, but it certainly shouldn't be something that you reach for initially, and that's definitely our approach too. So it does have a role. Robust offsets have a role, but it's only to address residual emissions.
Thanks, Seb. And that also, sorry.
Yeah. No, you go.
That also brings up another important point that somebody asked, talking about how do we validate our GHG reduction commitments and targets versus the GHG reduction outcomes in reality for our portfolio.
Yeah, so I guess there's sort of a couple of questions in there. In terms of the targets, we are now embarking on a piece of work to really dig down into the credibility of the targets. We're going to focus very much first on our large emitters. Like I said earlier on, 75% of our emissions come from just 5 companies. So we want to make sure that those are credible. In most cases, those have been validated by the Science-Based Targets Initiative, but we have our own framework for assessing how credible those targets are, or those commitments are. So we're going to do that piece of work this year. In terms of the reductions themselves, I mean, again, we are relying to some degree on the process of validation that the companies go through to make sure that when they report the data, that the data is accurate. There was a time, not that long ago, 8-9 years ago, when companies, I remember RWE misreported their greenhouse gas emissions by the size of Denmark. And ABB, interestingly, I don't know, I remember that they were the company, they added a 0 for 3 years in a row, an erroneous, out by a factor of 10 for 3 years before anyone noticed. I mean, we've come a long way since then. I don't think companies would get away with that. There's too much scrutiny now on these reported numbers, and so I think we can be pretty confident that the data they report is reasonably accurate. But the focus is very much on making sure that the commitments are credible, and there's some basis that we can be confident that they will achieve those.
Okay, great, thanks, Seb. I know you've been doing a lot of work on these carbon targets. Do we have any kind of looking into next year? What are other priorities on engagement topics?
Yeah, well, carbon is still a big focus. We have an ongoing focus on gender as well. If loyal readers of our impact report may remember that it's an area that we typically lag the benchmark, largely because we are of the kinds of companies we invest in that tend to be more sort of industrial technology, which tend to be or have historically been more male oriented. So gender is still an issue that for us, we've seen a significant improvement, but that's an area that we want to continue to focus on. Remuneration is an area, not just sort of overpaying your CEO, but linking incentive structures to ESG performance as well and sustainability performance. That's an area that we focus on. We kind of think about engagement really as being a set of proactive issues that we want to, lead on with companies, and gender and remuneration and carbon are those. And then inevitably there are lots of reactive issues as well where companies have a problem and we have to engage on it. But we've got more resource here as well. My colleague Rachel Montero, who's busily tapping away next to me here, she's going to be helping us deliver more sort of systematic engagement across the portfolios going forward.
Okay, thank you, Seb. I'll let you off the hook for a minute and back to Claire. We have some questions coming in on the themes in our portfolio. So we have 9 themes in our portfolio. One of the questions was, of these themes, where do you see the most attractive opportunities for 2023? Is it in a particular theme? Are there any particular holdings we have?
Yeah, it's a great question. I'd say the way that we tend to approach looking for new company ideas tends to not be at theme level. It tends to be much more organic and bottom up. That being said, I would say that looking at all of the policy developments that have been happening, after probably about a decade of quite weak policy development in cleaner energy, we would say that cleaner energy is an area that we are particularly excited about over the next decade. And so that's definitely an area that we're interested in. And more broadly, I think that it's really about taking advantage of market uncertainty, because that does tend to create valuation opportunities. We're not value investors. We don't tend to buy purely on valuation, but obviously when there's a high quality, really impactful company that we like, and it's available at cheaper valuation, that's something that we might be inclined to jump on. So we have seen, for example, a number of more cyclical companies have been trading down recently. Taking a long-term lens means we can look through the cycle and take advantage of that opportunity. And so that's really how we're approaching investment idea generation, I guess, for 2023.
Okay, great. Keep the questions coming in. We'll probably have time for about one more. Thank you for all those. Again, it's at the Q&A box at the bottom of the screen. Continuing on themes, and this is a question we get quite frequently in meetings. Looking at our themes, how do we approach the weighting? Would we change that? And would we ever consider adding a theme?
Yeah, so if I answered that perhaps. So we don't actively manage the thematic weightings. So we buy companies from the bottom up, which are impactful, which are growthy, quality oriented, and which are qualifying for our sustainable themes. So it's not that we're saying, right, we want 10% cleaner energy, we want 10% sustainable transport. It's just a kind of a byproduct of the investment ideas that we find and we like. That being said, we do have maximum limits. We do tend to have quite high weights in healthcare and in resource efficiency, because that's where we tend to find the most or the highest quantity of opportunities. And so we do have maximum limits as to the percentage that we can hold in each of those themes. About 30% is the maximum. But we don't actively manage that from a bottom-up perspective. And as to whether we would add a new theme, Seb might be better placed to answer this, but my sense is that essentially we always consider it. but we're very careful about adding new themes to our fund. And historically, I mean, the themes that we have been in place since 2009. I don't think they've changed in all of that time. So we're very thoughtful about making sure that we're only adding themes where we think it's, we think we can do that with integrity. A lot of companies, for example, a lot of our peers are starting to invest very systematically in like biodiversity, which is actually, we think, quite a difficult area to find impact in. So that's something that we're being quite thoughtful about. And yeah, we just want to make sure that we're maintaining our integrity and also making sure that we can actually find good opportunities in these themes as well.
Okay, great, thank you. We'll take one last question, and then for anyone whose questions we haven't answered, please drop me an email and I can get in touch. And again, I will be making the slides available after the call as well. I think this leads into one of our holdings really, Claire. And this is about real estate insulation investment opportunities in the portfolio, considering they have one of Europe's major emission contributors. How are we? Is there anything in our portfolio which speaks to this?
Yeah, so we definitely have companies in our portfolio which are kind of in a second degree exposed to the theme of insulation. So environmental consulting companies, companies which provide software for construction modeling, like Autodesk and things, they all help to contribute to that in a kind of second order effect. We don't currently own any direct insulation providers, but we have other exposure to the theme of efficient buildings. And one thing that we are quite big on in our portfolio is HVAC as well. So like heat pumps, energy efficient air conditioning units, which you'd be surprised at actually the amount of energy used by air conditioning units, especially in hot American states. It can actually be the biggest guzzler of energy in like California, for example. So yeah, we're very big on the theme of energy efficient buildings. We don't currently own any like direct insulation providers at the moment.
Okay.
If I could just very quickly add, just
Seb's favorite topic.
it's well, two things. One, yes, heat pumps, which are my favorite thing at the moment, which Claire mentioned, are a play on that in a way, because you're getting with a well-run heat pump, you're getting a coefficient of performance of 3, so you're getting 3 times as much energy back as you put in. So they're a significant way of making buildings more efficient, and of course you can run them off electricity, and so you can make it zero carbon as well. So heat pumps are doing extremely well in Europe at the moment, and we have a number of investments in them. The other point I just wanted to make is we have owned Kingspan in the past. In fact, it was one of our longest held stocks in the portfolio, and as some of you may remember, we sold it, I think it was end of 2020, off the back of the concerns that were raised around, well, Grenfell, and then what the inquiry revealed around Kingspan's governance. And we've documented this quite thoroughly in our reporting, so if anyone's interested, we can send it to you. But we were left still very uncomfortable with the governance at Kingspan, and so reluctantly in some ways sold it, because we certainly agree with the question that this is a critical part of the solution, making our buildings much more efficient, particularly, I might say, in the UK, where, as we all know, it's been pretty dire. But yeah, we're still very interested in it as an area, and there are other ways that you can play that.
Great, thank you, and thank you for everyone. We tried to get through as many questions as possible. Again, I'll be sending out the slides, and thank you for dialing in. We will be back in April talking about the first quarter, so hopefully we'll have some good news there to share, fingers crossed. And again, thanks again, and please drop me an email or give me a call if you have any questions or you'd like a follow-up discussion. Thank you and take care.